Good day everyone, thank you for joining me. My name is Matt. I cover the IT stocks for PSG Wealth, and in this presentation I'm going to discuss our latest report on the Walt Disney Company. Our latest report covers the third quarter results for 2021. The results show a consensus beat on the top and bottom lines. There was strong subscriber growth and a continued recovery in parks. Our report also shows that the financial position is improving as earnings recovers. There's a positive outlook on Disney with additional Disney Plus launches in new countries and a continued recovery in parks. And our recommendation remains neutral. So just looking at the results, we've got revenue which was up 44.5% to $17 billion. Operating income was up 116% to $2.4 billion, and EBITDA was up 88% to $2.8 billion. Net income was $920 million compared to a prior year loss of $4.7 billion, and earnings per share was 50 cents compared to a loss of $2.61 in the prior year quarter. And then looking at segmentals, there was a miss on media and entertainment distribution that was up 18% to $12.7 billion. The big beat came from parks, products and experiences, which was up 307% to $4.3 billion. And the DTC business was more or less in line with expectations, with growth of 57% to $4.3 billion. Disney Plus subscribers grew 11% quarter on quarter and over 100% year on year. The results were received positively. In aftermarket trading, the shares were up 5% after the results were released. On a year-to-date basis, Disney has underperformed the benchmark, which is up about 18%, bringing the underperformance since the start of the year to 17%. Over a longer period, Disney has performed in line with the benchmark in periods of over and underperformance. And then just looking at the assessment, the valuation multiples have come down over the last year or so. They were especially heightened during the period where parks and content was halted. That's recovering now, and the valuations are looking more reasonable. However, they have taken on a lot of debt when they bought 21st Century Fox, so we're keeping a close eye on the balance sheets. We show some graphs in the report which show that net debt to EBITDA is coming down, interest coverage is moving back up, and they've successfully converted a lot of short-term debt to long-term debt, which is mostly fixed, and that's going to be beneficial for when interest rates rise. We value Disney by applying the Netflix market value per subscriber to Disney subscribers, since we think that Disney should be worth at least as much as Netflix, since they've got a much more compelling offering. The legacy business is valued at its historical multiple before it pivoted towards streaming. And then we also show that normalized earnings is pretty much in line with the 5-year average, and our analysis leads us to a neutral recommendation. If you would like to place a trade, please speak to your financial advisor or contact the trading desk. Additionally, the report on Disney can be found on MyBase. Thanks for tuning in, and before we end off, please take note of the following disclaimer.